The Mortgage Minute today being brought to you by our friends at Geneva Financial when you're ready for that next home loan. Geneva's got the programs and the products. You just need to make the call. 800-306-1990, 800-306-1990. S&P 500 now up 2.45. 10-year Treasury flat 3.114. Mortgage-backed securities are down 5 basis points. And OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. Yesterday, the 30-year conforming loan locked at 5.808. Jumbo loans locked at 5.486. FHA loans 5.61. USDA loans 5.56. And the best loan on the market, in my opinion, for those that earned it, you cannot just apply. It's the VA loan, 30 years, 5.45. But what's going on? Why are these things happening? That's why you tune in to Ron Siegel Radio. So yesterday's news, obviously that affects the markets today. Cleveland Fed President Loretta Mester interviewed and used the word pain 9 times in her talk, taking the cue from Jerome Powell. She anticipates the Fed funds rate to be above 4% by sometime next year and to hold it there for some time. With the Fed funds rate currently at 2.25 and potential 50 to 75 basis points hike on September 21st, it means the Fed funds rate will likely be around 3%. According to her expectations, it could mean more rate hikes in the cards to get to her target of 4%. Remember, though, she is known as a flip-flopper. A year ago, she expected inflation to be between 3.5% to 4% by the end of 2021. Yes, and you know better than that. You know better than that. Yeah, she didn't get that one right. The Fed's also going to be in a tough spot because jobs are starting to deteriorate. And on that note, ADP is back with their employment data after taking a few months off. They're releasing their report, and they've actually given us 3 reports. So what did they do differently? Well, I don't know why they didn't do this in the past, but they are a data company. And they're also an employment company. They've got 25 million employees that they pay every pay period, right? They're the ones that are doing that. So let's think about this. 25 million people. Their report showed that there were 132,000 jobs created in August, 132,000, down from 270 in July and 380,000 in June. Obviously, the market is slowing. The report is independent. It's not the same as the BLS data, which uses a lot of modeling. And I like the idea of looking at what's actually happening. That just happens to be my opinion. But remember this. Here's the issue. Here's one that no one's going to talk about. Well, maybe next to no one. They reported the annual pay for those people who stayed at their jobs 7.6% year over year. That's important. I'll tell you why in a minute. Those who changed jobs saw their pay increase by 16.1%. So think about this. What does that mean? Because I hear folks telling us, the real estate market has to start crashing, has to start going downward because the number of people that are getting new loans is dropping. That's true. MBA released their mortgage application data for last week, showing that purchases fell by 1.8% last week and are down 23% year over year. Interest rates in the MBA version went from 5.65 2 weeks ago to 5.8 last week, a little over 2.5 higher than they were this time last year. Refinances decreased by 8% last week, are down 83% year over year. Refinances made up about 30% of all transactions. Got it. What's that mean for you? Well, if that you could look at that in a bubble, it would mean real estate prices would have to be dropping. But we can't look at these things in a bubble. We have to look at them in line with what else is going on in the world. What else? Well, people are not putting their houses up for sale. Why would they? Interest rates are extremely high comparatively. I'd say not extremely, comparatively high to what they were last year. Now, if you think about where they were historically, no, they're not high at all. But if you compare it to last year, the year before, they are higher. So what does that mean for a seller? Why would they sell? If you've got a 2.25%, 2.5%, 3% interest rate, unless you're going to make a killing on the sales price, why sell? There's no motivation. Well, that's what we're seeing in the marketplace. That's why I shared with you that last week we had about 535,000 single-family homes available for sale. The builders, they're seeing that the marketplace is slowing. They're seeing that the employment numbers are slowing. So what are they doing? They're not building as many properties. Of course they're not. They don't want to sit on inventory. They don't want to put their money into it. So we shared with you that even though we got the builder's report, when you look at what's actually completed, there's less than 1 month's supply of completed homes. Okay, if there's 1 month's supply of completed homes, you know something? That's not a lot of extra inventory coming to market. Add that to the people that don't have to sell, so they're not. And people are staying put. They're not putting their homes on the market. So even though interest rates are going up, even though the mortgage applications are going down, the prices are staying stable or increasing because there's no reason for somebody to sell. It's basic economics 101. I want to hear somebody that knows economics 101 explain to me how when you have a shortage of supply and you have a short demand, how prices are going to crash. They're balanced. They're balanced. So just think about that concept when you hear somebody saying, well, prices have to drop. And maybe people are not aging anymore. Maybe those 30-year-olds are not turning 31 and the 31-year-olds are not turning 32. Well, they're the ones that are the first-time home buyers. They're coming into the market. Now, I did see a report this morning that on the flip side of the scale, the 85-year-olds are not living to 85 anymore. They're living to 78. Just throw that out there for you. That's where the average ages are going. So those properties may come available because, you know something? You don't need a roof over your head if you've got dirt over your head. Just throwing that out the way it is. But we're still getting a lot of young people that are starting their families. They've got a reason that they want to purchase. So the demand is still there for a supply that is not there. Just think about that when somebody tells you prices are going to drop. Let's get back together a year from now and see where the prices are at the time. That is the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to call 800-306-1990, 800-306-1990.